A 34% drop in clean EBITDA is fairly significant on top of a fall of 16% in total revenue. What's behind those figures, and do you see that situation continuing for the rest of the year?
So clean EBITDA fell by 31.6 million euros year on year. There were a number of factors behind that fall, but the two main factors were clearly, first of all, the introduction of a turnover tax on sports betting in Germany. That impacted us by around 23.5 million euros. And then we also had further impact from migration losses when we brought the bwin and Party Gaming.com platforms together at the end of last year. There were, of course, some other factors, such as the impact of ISP blocking in Belgium, but certainly the main factors were the migration losses and the impact of the turnover tax in Germany. As we promised, we have made some significant cost savings in order to try and mitigate the impact of the turnover tax in Germany, and we're also working to ensure that the migration losses are also recovered in time. In terms of where do we expect to be for the full year, we have given guidance that we expect revenues now to be down between 14% and 17% for the full year, which compares to 16% at the half year.
The yield per player day has gone up in all businesses except bingo. What's behind the improvement in 3 of the product verticals and the decline in bingo?
So the new volume to value strategy is clearly the main factor behind the increase in the yield per active player day. But specifically in respect of sports, if we look at that year-on-year movement, last year we did have the impact of the Euro 2012, which can tend to attract an influx of the more casual player. So that would have impacted the year-on-year comparison there. And in bingo, where we saw the drop, we've seen some aggressive competitor activity in the UK, which has meant that bonus rates have risen. And also the euro strengthened against sterling, which has also had an impact on the yields.
While your distribution costs have come down overall, why have customer bad debts increased quite significantly?
Well, customer bad debts increased by 1.4 million year on year. When we look at payments overall, we don't try and optimize just one particular variable. We look at, for example, success rates on deposits. We look at the level of transaction fees for particular payment methods, as well as the level of chargebacks that arise from that particular payment channel. If you compare the increase in cost that we saw on chargebacks to the saving that we saw on transaction fees, that you'll see that the saving on transaction fees was around 5 times the increase in chargebacks. So the increase in chargebacks arose because when we brought the platforms together, we saw a change in mix of deposit methods, which we're very comfortable with, which has allowed us to reduce transaction fees significantly. So overall, that doesn't cause us any concern.
You say that you're on target for the 70 million euros of savings this year. Does this include savings made from the shift from volume to value, or are these in addition?
Well, effectively, that 70 million target that we gave really comprises 3 different areas of cost savings. It comprises the incremental synergies that we committed to at the time of the merger, and subsequently raised that target for 2013. It also incorporates the additional measures that we said we would take to mitigate the impact of the German turnover tax, as well as then additional savings in respect of the new volume to value strategy. So there are 3 components there.
You've said that you're on track to deliver at least 70 million of cost savings. Will those savings be reinvested in marketing, or will they fall to the bottom line?
Should we be in a position where we've exceeded the 70 million euro targeted savings this year, then we'll look at that time at what we think is in the best interests of shareholders. If we think we can generate a reasonable return on the investment in further marketing in certain markets, then we'll do that. On the other hand, if we think we've reached the optimal level of investment in those markets, then we would allow those savings to drop through to the bottom line.
Why have you changed the way clean EBITDA is calculated by vertical?
So in the second half of last year, we completed the reorganisation of the business onto one that is structured in respect of product verticals. This meant that we changed the way that we report information to the chief operating decision makers within the business. Under IFRS, we're required to report to the markets in a consistent way that we report the information to the chief operating decision makers. So that's effectively what drove the change. The principal changes are that now the vertical owners have full P&L accountability, and they have teams that are working directly within the verticals that we can attribute costs directly to each of those verticals, as opposed to having to allocate them from a central pool. So this should actually give rise to a more accurate allocation of costs between the verticals. One of the other changes that were made was that instead of allocating central costs on the basis of net revenue, any remaining central costs are now allocated on the basis of gross profit. And that is meaningful, particularly for the sports vertical, of course, after the introduction of the turnover tax on sports betting last year. The other change that was made was that the recognition of the cross-sell benefit from one vertical to another is better reflected now within the vertical split. So a number of changes have been made to the methodology, and they've effectively been driven by the fact that we reorganised the business in the end of the second half of last year.
Now, sports betting seems to have suffered the least in the shift from volume to value, despite the tough comparables and the German sports betting tax. Why is this?
Well, I mean, the first point in respect of the sports betting tax in Germany is that the tax recovery is still recognised within revenue. So that will be one mitigating factor. But just generally, if you look at sports betting and how that's been impacted by regulation, it seems to have fared much better than some of the other verticals, like casino, where we've seen, obviously, we've had to close down certain product offerings in particular markets, like France, where casino is not permitted altogether, in Spain, where they restricted the offering, and slots, which is the main component of casino, hasn't been permitted. And then in poker, where you have ring-fence liquidity in a number of these regulated markets, that's also proved to be problematic for that particular product vertical. Also, I think it's fair to say in respect of our mobile offering for sports that it is more advanced than for some of our other verticals. But that having been said, it's not where we want it to be, and we've got lots of exciting plans in that respect in the pipeline.
Other revenue is the only business segment to show growth, led by the World Poker Tour, but followed closely by your domain sales. Do you expect to make any further sales of these domains?
We've got thousands of domains in our portfolio, and selling domains and buying domains is an ongoing part of the business. But that having been said, the sales do tend to be rather lumpy, and they were particularly high this year. So the answer is yes, we do expect to make further domain sales. Will we expect them to be at the same level as in the first half? No, I don't think so. I would say for the second half it's probably going to be closer to €1 million of domain sales.
We might have expected a better net cash position by the end of this period. Is the business still generating cash?
Absolutely, the business is still generating cash. In the period, of course, we had a one-off item, which was the settlement of the Kentucky litigation. That was €11.5 million outflow. That settlement means that any potential litigation arising from our pre-UAGA activities is now finally settled. So we're very happy about that. And then, of course, don't forget that we also returned over €20 million of cash to our shareholders in the period in the form of dividends and buyback.
Can we expect the planned end of November launch into New Jersey to affect the end of year figures? And if that's the case, over what period would you anticipate seeing a return on the investment?
So New Jersey is a material business opportunity for the group. However, because the launch is going to be in late November, we wouldn't expect a material impact on revenues in the period. It being a startup, we will of course incur some startup losses in 2013 of between €5 and €10 million. 2014 itself will effectively be the first full year of launch. That will also generate a small loss, but close to break even, nothing too substantial, before we move into profitability in 2015. And that's when we would expect payback on the investment within 3 years.
What are your views on the performance in July and August?
Well, July was, if we look at the July last year, obviously was a difficult comparative month because we had the Euro 2012 finals. What's interesting, if we actually look at the current trading, is that we see the pickup now from July to August, which is encouraging. We actually see growth in all verticals. So it's obviously only early signs at this point, but we do have the new poker product launch, which is now imminent. We've got new mobile products coming on stream. So for us, looking forward now as we move out of Q3 into Q4, we would hope to see a return to growth. Slightly later than we had anticipated, but we always did say 2013 was a transition year. And now we hope to reap some of the benefits of investment that we made earlier in the year.
But despite this, you're expecting revenue and clean EBITDA to fall this year. Is that the case?
Yes, that is the case. So we always expected revenue to fall this year on the back of the introduction of the German turnover tax and the new tactic of focusing more on value as opposed to volume. However, it's also fair to say that the revenue drop will be greater than we anticipated, primarily due to some of the delayed product launches, in particular the new poker product, and also migration losses that were higher than anticipated. We're anticipating for the full year to be down on revenue between 14 and 17%. And on the back of the lower revenues, we also anticipate margins to be lower than last year as well, by around 2%.
And what about 2014?
So in respect of 2014, we would expect to return to growth. We have got, again, a number of new product launches to look forward to, which are all in the pipeline. We've got a number of new mobile extensions also due to roll out. And then on top of that, of course, we've got the New Jersey launch, which is scheduled for November 2013. And then on top of that, the benefit of the cost savings, some of the measures which we've taken already that are actually not going to flow through until next year. And in fact, we've given a new target for the market of an additional 20 million of savings in 2014 as compared to this year.